Okay, so you want to own a bank. Here's the strange part. A bank's entire business model is built on one promise, that your money is safe, available, and waiting for you whenever you need it. But the moment you deposit money into a bank, most of it gets lent to somebody else. That isn't fraud. That is the legal foundation of the modern financial system. Every major bank on earth operates this way, which means your savings account and somebody else's mortgage effectively exist at the same time. And the entire system only works as long as people remain confident they can get their money back whenever they want it. Silicon Valley Bank held over $200 billion in assets in early 2023. It collapsed in less than 48 hours. Not because it ran out of money, because too many people tried to withdraw it at the same time. By the end of this video, you'll understand exactly how banks create profit, why confidence matters more than almost anything else in finance, and why owning a bank is less like owning a normal business and more like managing controlled instability. There are basically three levels to this business. At the bottom, community banks and credit unions. Local operations serving a single city, county, or region. Mortgages, small business loans, consumer banking. Relatively small balance sheets, thin margins, strong local relationships. Then there's the middle tier, regional banks, billions in assets, multiple states, commercial lending, investment services. These are the institutions most people barely notice, until one suddenly collapses and dominates financial headlines. And finally, the top tier, JPMorgan Chase, Bank of America, Citigroup, Wells Fargo. Institutions so large the government has effectively concluded they cannot be allowed to fail without threatening the broader economy. But before you can own any kind of bank, there's one major obstacle: regulation. Bank charters are extremely difficult to obtain. The approval process can take years. And after the 2008 financial crisis, new bank approvals became extraordinarily rare, which creates one of the strongest competitive moats in the entire economy. Because existing banks aren't just protected by scale, they're protected by regulation itself. There are basically three ways in. First, build one from scratch. Raise capital, hire compliance teams, apply for a charter. Spend years navigating regulatory reviews before opening your doors. Possible? Yes. Common? Not remotely. Second option, buy an existing community bank. Thousands of small banks still operate across the United States. Many are undercapitalized, aging, struggling with succession planning, or simply too small to compete long-term. This is how many banking groups expand. One acquisition becomes another, then another. But the third path is the most important one historically. Buy during a crisis. Jamie Dimon expanded JPMorgan aggressively during the 2008 financial crisis. Bear Stearns collapsed, Washington Mutual failed, and JPMorgan acquired massive assets at distressed prices while the financial system was panicking. That's one of the recurring patterns in banking history. The biggest fortunes are often built during periods when everyone else is trying to survive. Now let's say you own a mid-sized regional bank. The doors haven't even opened yet. Your costs are already enormous. Compliance alone costs millions every year. Banks require anti-money laundering systems, cybersecurity infrastructure, fraud detection, stress testing, internal audits, risk management teams. Then deposit insurance premiums, technology infrastructure, branch operations, legal teams, credit analysts. A single serious data breach can cost millions before regulators even become involved. And then there's the most important cost of all, confidence. Because a bank's most valuable asset is not its cash, it's public trust. The moment depositors begin questioning whether their money is safe, the business model itself becomes vulnerable. That's the terrifying thing about banking. Fear alone can become financially real. At first glance, banks make money the obvious way. Take deposits, issue loans, collect the difference between interest paid and interest received. That spread is called net interest margin, and across enormous loan portfolios, it generates billions. But the hidden layer is much stranger. When a bank issues a loan, it usually doesn't physically transfer existing depositor cash into the borrower's account. Instead, the bank creates new money through accounting entries tied to the loan itself. A mortgage worth hundreds of thousands of dollars can effectively appear the moment the loan gets approved, which means banks are operating under a system where lending itself expands the money supply. Banks are legally licensed to create money. And historically, the biggest limitation wasn't the physical amount of deposits sitting in vaults. It was regulation and capital requirements. But even that isn't the deepest layer. The fee system matters enormously too. Overdraft fees, wire fees, loan origination fees, asset management fees, account maintenance fees. Major banks generate tens of billions of dollars annually from fees alone. And unlike lending margins, fee revenue often survives economic downturns remarkably well. The fee machine keeps running in good economies and bad ones alike. There are three things most people misunderstand about banks. First, people think banks simply lend out depositor money directly. Modern banking is much more complicated than that. Banks create new credit through lending itself, constrained primarily by regulation and capital structure. That's why the banking system can expand the broader money supply far beyond the amount of physical cash sitting inside branches. Second, people assume deposit insurance makes the system safer for banks. In reality, it also changes depositor behavior. Because insured customers rarely investigate whether their bank is operating responsibly, the downside risk partially shifts to the government, which can encourage aggressive behavior inside the financial system over time. And third, people assume large banks are more fragile than smaller ones. Historically, the opposite has often been true. The largest institutions typically have cheaper funding, stronger political relationships, deeper liquidity access, and implicit government support during crises. In banking, scale is often a form of protection. In March 2023, Silicon Valley Bank collapsed with stunning speed. For years, SVB had become the dominant bank for venture-backed startups and technology founders. The bank accumulated enormous deposits during the low interest rate boom years. Then, management invested large portions of those deposits into long-duration government bonds, safe assets, at least normally. But when interest rates rose rapidly, those bonds lost significant market value. Suddenly, SVB was sitting on billions in unrealized losses, still survivable, until confidence disappeared. Prominent investors advised startups to withdraw funds. Founders messaged each other. Group chats exploded. Withdrawal requests accelerated instantly. In a single day, customers attempted to withdraw tens of billions of dollars. The bank couldn't liquidate assets fast enough, and regulators shut it down almost immediately afterward. SVB wasn't destroyed by criminal fraud, or reckless subprime lending, or some exotic financial instrument. It was destroyed by the oldest problem in banking history. Too many people wanted their money back simultaneously. Only now, the bank run happened through smartphones and group chats instead of lines outside branches. Now imagine the optimistic scenario. You run a disciplined regional bank, strong underwriting, stable deposits, conservative lending. Over decades, the institution compounds steadily. You acquire weaker competitors during downturns, expand carefully, avoid catastrophic credit mistakes. This is how some of the largest banks in the world were built. Now the realistic scenario. Commercial real estate weakens, defaults increase, depositors become nervous, funding costs rise. You haven't necessarily made reckless decisions, but banking is deeply tied to the broader economy, and when enough pressure hits simultaneously, even well-managed institutions can become unstable very quickly. That's one of the hardest truths about banking. Sometimes survival depends less on intelligence and more on which economic cycle you happened to enter at the wrong time. In 2023, JPMorgan Chase generated more profit than any bank in history. And it did so using a system that fundamentally hasn't changed for centuries. Take money from people who have it. Lend money to people who need it. Charge more for lending than you pay for deposits. The math itself is simple. The danger comes from trust. Because banking only works when enough people believe the system is stable. The moment too many people panic simultaneously, the entire structure starts becoming fragile. And that cycle has repeated over and over throughout financial history. Booms, confidence, leverage, fear, bank runs, consolidation. Then, eventually, the process starts again.